Tesla stock is trending downwards, which should be no surprise to anyone. In their last earnings call, they said, in 2024, our vehicle volume growth rate may be notably lower than the growth rate achieved in 2023. Now, analysts have already forgotten Tesla said this, and we can expect shares to slump as today's fickle investor moves on to some other AI growth story. Through 2024, when they don't meet analyst expectations, the share price will undoubtedly correct as well. So we've come up with a $127 target price for Tesla, and we're going to explain why that is. Now, I think there are 4 common rookie mistakes that newbie investors make. The first would be not understanding the difference between passive and active investing. We did a video on that particular topic, and this is where somebody says, well, BlackRock is holding my sacred cow, not realizing that BlackRock is one of the biggest passive investors anywhere, which means that they don't understand or care to understand why they're holding most stocks that they are. Another would be trying to read into insider selling. So you really need to put a lot of context around insider trades, especially when they're sales, and even then you're not likely to get any signal that's useful. Then another mistake they make is looking at corporate investments as evidence that the corporation is bullish on a particular stock, when in fact you may have a situation where companies do business with a large company in exchange for a press release that says they're quote-unquote collaborating. We see this now with NVIDIA in some instances. And probably the worst and most commonly observed mistake is providing a price target without justifying how you arrived there. These are the same people who say things like, oh, such and such a stock is an easy 10x from here. All they're doing there is damaging their credibility. So we have a new proposed rule. Anyone who cites arbitrary stock price targets on Twitter is required to provide supplementary valuation justifications for those prices, and these need to be calculated manually from data sourced from reputable vendors. Now, today we're going to talk about valuing Tesla, and there's a number of approaches we can take to that. Now, the first and perhaps most common would be to use the current price-to-earnings ratio. Then, of course, for companies that are growing very fast like NVIDIA, you can use forward-looking PE ratio. We've done that before in a video that proposed that NVIDIA wasn't particularly overpriced if you used that approach and took into account the midpoint of analyst estimates. Then there's what we use here at Nanalyze, which is a variation on price-to-sales ratio. It's called simple valuation ratio, and we did this video here to explain why we use simple valuation ratio, or SVR. The main reason is that most disruptive tech companies that we cover aren't profitable, so price to earnings isn't going to work. Neither is price to cash flow, but revenues will always be there, and these are a proxy, and if they're not there, we don't invest or even look at companies without revenues. Revenues are a proxy for market share being captured. So if a company is truly disrupting something, then they ought to have the revenue growth to show for it. Now, if we look back at some pieces we've done previously on Tesla, in July of 2020, we wrote a piece titled, "Here's Why Short Sellers Are Shorting Tesla." And at that time, shares were trading at a simple valuation ratio of 14.5. Now, 4 months prior to that, they actually traded at an SVR of 4, and that was when the Rona impacted the markets in March 2020. So we know that's a potential valuation target that Tesla could trade at. Now, in December of 2022, shares traded at a SVR of 5.5. We're actually there now. And at that time, we proposed, just based on the lows that Tesla had seen before, that it could possibly trade at around $108 a share. It ended up trading in that range. Now, what could they trade at today? Because the simple valuation ratio uses revenues, and those were different back then. So what we can do is look in our tech stock catalog, and one of the sheets in this Excel worksheet is the historical data needed to calculate an average SVR for, 190 stocks in the catalog. So let's calculate Tesla's SVR based on today's data. This is our simple valuation ratio. We take market cap of $546 billion, last quarter's revenues of $25.2 billion, let's call that 101 annualized. That gives us a current SVR of 5.4. So the The current SVR for Tesla is below average, but how low can that SVR go? Well, to at least 4. But what did we see during the last dip when it hit 108 per share? Well, you can see that here when that last dip was. It was in early January 2023. The trading range at that time on that particular day was between $102 to $119. So that was within our previous target of 108. So let's take a midpoint there and let's calculate market caps. And we need to use the shares outstanding at any given time. So we've done that today. We take the 3.185 billion shares times the price, we get $545 billion market cap. We can cross-check that with Yahoo Finance. That's where we're pulling this data from. The reason we use Yahoo Finance is so that everybody can access a similar data set and we're all on the same page. Now we can calculate the shares outstanding or take the shares outstanding in price back in January of 2023, and we see the market cap it traded at then, $348 billion. Now we can do the SVRs, and we see that on that last dip, it traded at an SVR below 4, 3.6. So let's go ahead and set our target SVR where we'd buy shares at 4 to provide some buffer. Based on that, our target price for Tesla shares would be $127 a share. So you can do the math. A market cap of $404 billion divided by the simple valuation ratio of 4, and we get 101, which is the annualized revenues. So we have our target price now for Tesla, but what other people will correctly argue is that Tesla is overpriced even at that simple valuation ratio, and they're probably right. Now, before we get into that, I wanted to quickly point you to our free newsletter, Nanalyze Weekly, and we're going to put a link to this in the comments section of this video. Please sign up. This coming newsletter, we're going to be sending a artificial intelligence knowledge base we put together over the past decade that contains 5,500 words on investing in artificial intelligence and links to dozens of research pieces. It's quite rich. It's free. We're sending that out in our next newsletter, so make sure you sign up. So people will say Tesla is priced extremely rich for an auto company, and they're absolutely right. And we can tell that by looking at price to earnings ratio. So we can, again, do the math. We take the current share price of $172.32. We take diluted earnings per share, so you want to make sure you get the right number there. Then we can calculate their current PE ratio. So 172 divided by 4.73, we get 41. Cross-check that with Yahoo Finance at 40. That's close enough. Now, since the NASDAQ trades at a current PE of 32, we know Tesla's more richly priced than the NASDAQ. So what? What we really need to do is compare apples to apples. So we want to see how Tesla compares to automakers. And good data is very tough to find. But this gentleman here, a subscriber pointed us to him, and his work is very valuable. His name is Aswath Damodaran, and he teaches corporate finance and valuation at Stern. So he calculated the PE ratio for auto and truck makers at around 20. You can see forward PE trailing. It's roughly around 20. So Tesla, theoretically, should be trading at half price if it's competitive with other auto and truck makers, but one would argue it's actually a much better business, and these charts show you why. So we need to price in the disruptive potential of Tesla, especially now that they're retooling to compete on cost. That's the reason they expect lower volume this year, is because they're ramping up their new platform. But let's not go too far down this rabbit hole. All we're trying to point out here is that Tesla's growing at a much faster rate than leading automakers such as Ford and GM. They're also generating a lot of cash flow, which they can use to grow their business. So Tesla is, by all measures, an automaker. 86% of their revenues are automotive. Now, you could say they should be trading at around half price without the premium. Go ahead and say it. They should be trading around $100 a share. People like round numbers. But what we need to pay attention to here, and this is the expectation, this is ARK Invest's thesis, is that more than half the value of Tesla is in their future deployment of autonomy. Let's forget about the robots and energy storage and other bits they're working on. ARK really believes that autonomy is a massive potential for Tesla. So in order to see when that starts to become meaningful, pay attention to services and other in how that grows over time, because that bucket's going to contain all those other bits they're working on. And when they finally get meaningful enough, they'll break them out into more segmentations here. Now, this year for Tesla, you should get used to disappointment. We see here, this is again taken from Yahoo Finance, that analysts didn't really pay attention to that. They still are expecting close to 12% growth for Tesla this year based on revenue growth and all that comes with that. So when Tesla says their vehicle volume growth rate may be notably lower, it doesn't seem like analysts paid much attention to that. So what's the biggest risk for Tesla? Well, it's the double-edged sword who runs the company.
Go yourself.
So Mr. Musk could pull an Amy Winehouse. That would certainly throw a monkey wrench into the Tesla machine. The government could provide obstacles every step of his way when it comes to realizing his autonomy thesis. That's probably our biggest concern regarding the future potential of Tesla. He could certainly get too distracted with too many irons in the fire. The one could argue he's always had that, etc., etc. But he's also the world's most accomplished entrepreneur by any measure, and certainly has a track record of success, despite what individuals like this quote-unquote notable tech journalist come political analyst said. What's the opposite of progress? Elon Musk 2023. So you need to be very careful what you read about in the media and just pay attention to numbers as a Tesla investor. So just some parting thoughts. If you're investing in a car company, then things are just fine. The problem is that you're not, and the valuation reflects something different. Therefore, to realize the valuation, we need those tails Musk is spinning to start coming true, and that may take a while. He's trying to do very grand things. Some may come to fruition, others not. Now, what you're betting on here with that excessive valuation is the world's most successful entrepreneur. And has he run out of luck? Well, the harder you work, the luckier you get, and Musk certainly works very hard, so we would never bet against Tesla. And I'll leave you then with another video here. Please make sure first to go into the comments section and click the link to sign up to our newsletter, and then watch this next video on the rumors of Tesla's death. It's quite edifying. So thanks so much for taking the time to watch this video today.